Hello, my name's Ben Williamson and I'm Associate Director at Clive Owen Corporate Finance. As a specialist corporate finance team, we provide expert advice on a range of corporate transactions, including acquisitions, investments, disposals, management buyout and fundraising. Today, I'm going to give an introduction and overview of how a service called Financial Due Diligence, commonly shortened to DD, can provide insight and support in acquisitions and investments. I have a Big Four accountancy background where I specialised in DD, and I firmly believe that the value due diligence brings to a transaction means that a professionally delivered DD investigation pays for itself many times over. I hope you enjoy this short video and find it useful. My contact details are included at the end, so if you or any of your clients would like to talk further about how we can help, I'll be delighted. Thank you very much for your attention. So what is due diligence? Well, possibly a good way of understanding it would be to say that the purchase of a business is quite similar to the purchase of a house. Typically you'll have a seller and a buyer, and the buyer will normally be looking to raise funding from a bank to buy a house. Well, the same is true for buying a business. And much as when buying a house you might want a survey performed on the property to make sure that it's worth the purchase price, due diligence is exactly that process, but for a business. It ensures that the business is worth the price that you're about to pay. Why else would you do that? Well, it gives you a third-party record that shows that you've taken independent advice on whether or not a transaction is worth pursuing. It's evidence that the directors of the purchasing company have taken due diligence in their process, hence the name. And finally, a well-written due diligence report should also enable those directors to make a well-informed decision on whether or not to proceed with the transaction. So under what circumstances might you perform due diligence? Well, we've touched there on buying a house, but if you were buying a business, clearly you might want to have someone come in and make sure the price you're about to pay was worth it. There are broadly sort of two forms of due diligence there. A lighter touch confirmatory kind of due diligence, which you might want if you're, for example, a buyer in the same sector as the target company you're looking to acquire, or you might want something more detailed, either because it's something which is out of your comfort zone, out of your sector, or indeed if you want to use due diligence as a method for reducing the price that you're about to pay. Also, lenders or investors in a transaction, whether that's to fund a purchase or whether it's for refinancing, might also want due diligence, and they're more interested in whether or not a business will be able to repay the investment they're about to make out of its future cash. A third-party report would clearly help smooth the credit or investment process there as well, and would also be very useful when looking at covenants, either giving an opinion on whether covenants about to be set with facilities are too lenient and therefore not that meaningful, or whether they're too tight and will therefore be a distraction to the management team. The next couple of slides will deal with what a normal or vanilla scope might look like, and then what a more detailed or tailored scope might look like as well. So what does that basic vanilla scope look like? Well, typically you would look to attack the value year in a transaction. So if you're purchasing a business based on its 2014 profits, that would clearly be a focus of a due diligence exercise. And normally businesses are bought on multiples, so an adjustment to 2014's profits would be multiplied through that multiple and come off the transaction price. It should also focus on working capital at completion. You wouldn't expect to buy a supermarket and for there to be no stock on the shelves the day that you walked in, because then you'd have another check to write the day after you've just written a big one for the transaction itself. And finally, there should be some focus on debt and cash as well. Typically, any cash in a business would be bought pound for pound, but debt should be deducted from that amount. And debt can be quite nuanced. For example, an outstanding corporation tax liability, whilst it doesn't feel as intuitively debt-like as a bank loan, does still represent a historical liability that the vendor should settle before a transaction. What would a more detailed or perhaps investor-relevant scope look like then? Well, it's all well and good attacking a single year's profit, but actually an investor's looking for what normal looks like. It's that maintainable profit that they're after. Why? Because it's out of maintainable profits that their investment will be repaid. And whilst profit, or EBITDA, that's earnings before interest, tax, depreciation, amortization, is a useful P&L measure, it doesn't actually measure cash flow from the business. So things like operating cash conversion, i.e. how much cash is absorbed by working capital, or indeed capital expenditure, CapEx, become important as well. Also, acknowledging that that investments are repaid out of future profits, forecasts become more interesting as well. They become more relevant. So our reviews would always look to attack the underlying assumptions in forecasts and make sure that they are on a par with historical norms. And again, as mentioned previously, that review of forecasts will help with covenant compliance as well. But finally, the other thing that financial investors in particular find interesting are those non-financial matters that come out of review. What are the management team like? How easy was it to get the information out of them? There are a number of other non-financial benefits to due diligence as well. We've just mentioned boots on the ground there, getting into a business and getting under its skin. What does it feel like? It also introduces a third-party buffer. If there are going to be price negotiations, it's quite nice to be able to pedal out the line. This is what my advisors are telling me. It makes that process a bit more, it makes it less personal. Clearly, outsourcing the work reduces workload for the acquirer. And finally, and crucially, a well-written due diligence report should reduce the investment risk as well through all the means noted above. Buying a business. I hope you found that video useful. My contact details have been included at the end, and I'd be absolutely delighted to talk to you about any further clarity you might want on the items discussed or how we might be able to help you. Thanks very much again for your attention. Bye-bye.